Everybody's been talking about crypto lately, and blockchain technology has experienced a seismic shift in 2024, driven by three factors: the Bitcoin halving event, the subsequent bull run, and increased institutional and government acceptance of the digital currency. So these developments not only reshape the crypto landscape, but also influence various industries, particularly finance, which affects our daily lives. So in short, it's time everybody gains an understanding of what it's all about. So in this video, I'll be exploring what blockchain technologies are, particularly cryptocurrencies, how they work, and why they're becoming increasingly important for today and of course for tomorrow. So why does blockchain exist and what are its uses? Well, blockchain technology emerged as a solution to several challenges in the digital world, particularly in the areas of trust, security, and transparency. Its creation was driven by the need for decentralization, which is to reduce the reliance on central authorities, governments, or financial institutions, etc., or the intermediaries in transactions. Secondly, enhance security to protect fraud and unauthorized changes to data. And thirdly, increased transparency. So this is to provide a verifiable and immutable record of transactions. So as a result, blockchain has found applications in various fields, including cryptocurrencies, the most well-known use, enabling secure and decentralized digital currencies like Bitcoin and Ethereum, which we'll be looking at in this video. Supply chain management, tracking products from manufacture to delivery. Healthcare, where we're securely storing and sharing patient records. Voting systems, ensuring transparent and tamper-proof elections. And smart contracts, where we're automating contract execution when predefined contract conditions are met and embedded in software code. So let's now dive into blockchain at a deeper level and how it works. So what is it? Well, it's a digital ledger of transactions. So imagine a giant shared notebook, if you like, just to simplify the concept, that everybody can see, but no one can erase or change. So each page on the notebook is like a block, and it contains a list of recent transactions or information. So here's how it works. Firstly, when something happens, like a payment, for instance, it's written down on a new page. Secondly, many people check or validate it to make sure that the information is correct. Thirdly, once everybody agrees that it's correct, the page is sealed and can't be changed. And fourth, this page is then linked to all previous pages, forming what's called a chain. Okay, so the key features of blockchain as a result are that there's shared responsibility. So instead of one person keeping the notebook, everybody has an exact copy. There's transparency. Anyone can look at the notebook and see what's written. Thirdly, you can't change it. It's unchangeable. Once something is written and sealed, it can't be erased or changed. And lastly, for security, because everybody has a copy, it's nearly impossible to fake or change the records without anyone noticing. So you're starting to see the benefits here. Now, I just need to add that there's two types of blockchain. There's public blockchain and there's private blockchain. So firstly, public blockchain is, say, imagine a community bulletin board in a town square. So anyone can post messages or read what's there. So it's open to everybody. Bitcoin is a public blockchain where anyone can join and participate. And then you've got the private blockchain, which is where we might think of a company's internal message board, okay? So only employees of that company can post or read messages, so it's restricted to specific users. So for example, a company might use a private blockchain to keep track of sensitive internal information. So the key differences between the two, well, not only are the private blockchains actually more private or exclusive to certain members, but they can be faster as well. For instance, if you imagine a private road with less traffic compared to a public highway, which is crammed full of cars. So obviously there's less congestion in the system of the private blockchain. So the type of blockchain technology we're going to look at today are cryptocurrencies. So these are digital virtual forms of money that operate in networks that use the blockchain technology that I just talked about. So these emerged as an alternative to traditional financial systems, with Bitcoin being the first and most well-known cryptocurrency. So a key point about cryptocurrencies is their digital nature. They only exist in digital form, like the balance of your online account. They're decentralized, and because it's blockchain, no single authority controls them, unlike traditional money controlled by banks and governments. They're secure, where they actually use advanced encryption techniques, similar to how online banking protects your information. And this is actually unlocked by what we call miners. More on this later. So variety, there are thousands of cryptocurrencies, each with its own features, like different brands of a product. So cryptocurrencies offer several benefits. They're basically fast and cheap international transfers. So unlike traditional banking systems, cryptocurrency transactions are processed quickly, often within minutes, regardless of geographical boundaries, rather than days. The fees for these transfers are typically lower than those charged by banks or money transfer services. They offer increased privacy. Cryptocurrency transactions offer a degree of anonymity, as they don't require personal information to be shared. They protect against inflation. So many cryptocurrencies like Bitcoin have a limited supply, okay, which can potentially protect against inflation. So this is in contrast to traditional, what we call fiat currencies, like say the US dollar or British pound, which could be subject to inflation due to particular government monetary policies. Now, I'm going to actually explain more about this later on, so we'll come back to the concept. And accessibility. So anyone with an internet connection can access cryptocurrencies, so potentially providing financial services to unbanked populations in regions, say remote regions with limited access to traditional banking. So let me describe the cryptocurrency transaction process for you. So I'm going to use a simple example where Alice would like to buy a shirt from Bob's clothing store using cryptocurrency. Okay, so prior to the transaction, both parties need to set up what's called a digital wallet. Okay, so for the creation of this digital wallet, Alice, the customer, creates this digital wallet to store and spend cryptocurrency. Alice, as she does this, gets what's called a public key, like her account number, and also gets a private key, like her secret PIN or identification number. Bob, the store owner, also creates a digital wallet to receive the payments, okay? And as a result, he gets his own public key and own private key. So once this is done, Alice can acquire the cryptocurrency to purchase with, okay? So Alice buys the cryptocurrency from a cryptocurrency exchange, say like Coinbase, which is then stored in her wallet. So the purchase process goes as follows. Firstly, the transaction is initiated. Bob displays his wallet's public key, perhaps as a QR code, at the checkout. So Bob shares his public key so that Alice knows where to send the payment. So it's safe to actually share publicly, just like a bank account number. Alice scans Bob's public key with her wallet app and then enters the price of the shirt as the payment amount. The second step is authorizing the payment. Alice uses her private key to sign the transaction. So don't forget, the private key is only known to her. This proves she owns the cryptocurrency and authorizes the payment. Alice's wallet app then broadcasts the signed transaction to the cryptocurrency network. The third step is that the transaction is then verified, okay? So The cryptocurrency network receives Alice's transaction details and adds it to a pool of pending transactions. That's transactions made by other people. Fourth, the mining process then occurs. This is that validation process I talked about recently. So miners who are not Alice and Bob, but other network participants, pick Alice's transaction along with others of those pending transactions to form a block. These miners are working against each other to compete to solve or unlock the mathematical puzzle first in order to validate the block, okay? And the reason they're competing against each other to confirm this transaction first is because there is a reward involved. So fifth, confirming the transaction, the successful miner solves that mathematical puzzle and adds the block to the blockchain. The cryptocurrency network then verifies the solution and updates the blockchain, and also actually rewards the successful miner in the form of new coins, as I just mentioned. That's the reward they get for being the first to verify the transaction or unlock that code. And lastly, to complete the purchase, Bob's wallet receives notification that the payment has been confirmed. So Bob sees that confirmation and then finally gives Alice the shirt. So here, a blockchain's role is to act as a public ledger, recording that transaction which is visible to anyone, although, as I said, anonymous, and allows Bob to verify he received the payment without having to trust Alice, okay? So this mining is absolutely crucial to the cryptocurrency ecosystem and serves multiple purposes. It's the transaction validation, where miners verify the validity of those transactions before adding them to the block, after which they can't be changed. It provides that network security, where the computational work involved in mining or the unlocking of the code or solving of the mathematical puzzle actually secures the network against attacks, and that's fantastic. It also creates new coins. So mining is the process by which new units of cryptocurrency are created because of the rewards given to the miners for solving the puzzle. And it also acts as a consensus mechanism. So many cryptocurrencies use what's called a proof of work or POW system, where mining serves as the consensus mechanism to agree on the state of the blockchain, okay? Now with the coin itself, there's this element of supply control that I touched on before. So most cryptocurrencies have a hard limit to how many can exist, all right? Bitcoin, for example, has a cap of 21 million, and I'll tell you a little bit later why this is important and relevant. The mining process is not separate from transactions, but is actually an integral part of how transactions are verified and added to the blockchain. So the system actually creates a decentralized, secure, and transparent method of transferring value in digital form. So now I'd like to dive deeper into two forms of cryptocurrency, probably the most popular, which are Bitcoin and Ethereum. These are the two most prominent cryptocurrencies, each with distinct purposes and features. So to understand their roles in the digital finance landscape, let's explore their key characteristics and differences. Bitcoin, well, that was the pioneer of digital currency. So this was launched in 2009 and was the world's first cryptocurrency. So its primary function is to serve as digital money. Its origin was created as an alternative to traditional currencies, particularly in response to the 2008 financial crisis. And the purpose is often compared to digital gold, if you like. So Bitcoin primarily functions as a store of value and a medium of exchange. So what I mean by store of value means that Bitcoin is seen as an asset that can maintain its purchasing power over time and can be reliably saved, stored, and retrieved without significantly losing any value. In terms of technology, Bitcoin operates on its own blockchain, which is a digital ledger that records all transactions. Ethereum, on the other hand, which was introduced in 2015, expanded the concept of cryptocurrency beyond just simple financial transactions. So it's developed this dual nature where it functions both as a digital currency called Ether and a platform for building applications. So the key innovation here is that Ethereum introduced what's called smart contracts, which are the self-executing agreements with the terms which are directly written into the code. Their versatility allows developers to create what's called decentralized applications that even perform various functions beyond money transfers. So the key differences between Bitcoin and Ethereum are purpose. Bitcoin aims to be an alternate form of money, whereas Ethereum serves as a platform for running decentralized applications. In terms of functionality, Bitcoin primarily handles financial transactions, whereas Ethereum can execute complex operations through these smart contracts. In terms of speed, Ethereum generally processes transactions faster than Bitcoin because it only uses the power of someone's laptop or mobile phone as opposed to specialized hardware equipment that mining actually uses in the Bitcoin process. And of course, as a result of this, the environmental impact of Bitcoin that uses this energy-intensive mining to create new coins is obviously a much higher energy use than Ethereum, which is actually transitioning to a more energy-efficient method called staking, done from a user's computer or mobile phone, as I said. So Ethereum's transition from mining to staking, known as Ethereum version 2.0, marks a significant shift in cryptocurrency technology. The first most important part of this is staking is expected to reduce Ethereum's energy consumption by approximately 99.95% compared to mining, which is staggering. So how staking works, validators are actually chosen based on the amount of cryptocurrency they stake as collateral. So what I mean by that is how much Ethereum they put up and what they could lose if they perform malicious type activity. Okay, so this typically requires 32 Ether to put up and become a validator. Validators run automated validation software from either their desktop or mobile phones. So if the validators behave maliciously or don't perform their duties, there'll be the following penalties involved. One of them is slashing, which is actually a severe penalty for this malicious activity or fraudulent activity, resulting in a loss of that staked Ether that was put up. And the other is the inactive penalty, which is the minor penalty for not running that validation software consistently as promised. So the comparison to mining. So mining requires solving complex mathematical problems demanding significant computational power on specialized equipment using large amounts of energy. It's basically the difference between using the amount of energy needed to power a household versus the energy needed to power a laptop or mobile phone. Okay, so that's a big difference. In simple terms, if Bitcoin is like digital gold, Ethereum is more like a programmable digital computer that can also be used as money. I used Bitcoin and Ethereum as good examples to show that difference between the mining done in Bitcoin and staking done in Ethereum, and to highlight the differences in the massive differences in the energy consumption between the two, because a lot of existing cryptocurrencies will actually move or transition to that staking for that energy reduction, as well as the fact that new cryptocurrencies are taking on that staking process by default. So I can't talk about Bitcoin without mentioning the Bitcoin halving event. So this is probably the most significant event in cryptocurrency. This occurs approximately every 4 years and plays a crucial role in Bitcoin's economic model. So during this event, the reward for mining new Bitcoin is actually cut in half, which sounds a bit harsh, but there is a purpose to this. So The purpose of the halving is to control that supply. And how it does this is it mimics the scarcity of precious metals like gold and ensures Bitcoin's fixed maximum supply of 21 million coins is actually approached gradually, okay? And this actually helps control inflation, which actually maintains Bitcoin's value over time by reducing the rate of new coin creation. So to understand how it counters inflation, let's compare it to the traditional or fiat currencies. So with the traditional fiat currencies like the US dollar or Australian dollar, governments can actually print unlimited amounts of money, as you may know. We saw a lot of this during COVID, and during times of economic downturn, they want to get people spending, so they print more money, okay? In effect, it's to stimulate the economy. So what this means is that more money in circulation often leads to increased consumer spending, right? Which results in higher demand for goods and services. Now, so with this higher demand for goods and services, price increases will result if there's not enough goods and services produced to meet this high demand, okay? So what this means is that there's more cash chasing the same amount of goods and services, which, as you would expect, leads to price increases. The result is inflation from decreasing purchasing power of the currency because as more money enters circulation, each unit of currency becomes less valuable relative to those goods and services, okay? So this means you need more units of currency to buy the same amount of goods and services. To counteract all this, Bitcoin's approach is to have a fixed maximum supply of 21 million coins, as I've mentioned, and the halving every 4 years reduces the rate of new Bitcoin creation over time. So the overall result is the maintaining of this scarcity of this asset and potential preservation of the value. So by controlling the supply of new Bitcoin entering circulation, okay, the halving mechanism aims to prevent the devaluation that often occurs with traditional currencies, as I've explained, potentially preserving Bitcoin's purchasing power over the long term. So the effects of the halving are firstly scarcity, as I've mentioned, where the halving reduces the rate at which Bitcoins enter circulation. Secondly, mining profitability. Miners receive fewer Bitcoins for their efforts, which can impact the mining ecosystem. And market dynamics. Historically, halvings have been followed by significant price movements, often upward, although, of course, past performance doesn't guarantee future results. Institutional interest, well, 2024 was the year that halving saw unprecedented institutional involvement, like with the approval of Bitcoin ETFs or exchange traded funds, which are like managed funds, but you buy and sell on an exchange. And of course, increased corporate investment as a lot of corporations are, finally seeing this as a legitimate asset class or even recognizing it as an asset class in the first place and going through their own due diligence, which actually can take a bit of time, 6 months to a year for some places. So they might have a bit of a lagging effect before they jump in, but popularity is exploding at the moment. So, of course, long-term supply, the halving ensures that the last Bitcoin won't be mined until about the year 2140. So that maintains its scarcity for over a century. So one other cryptocurrency I'd like to talk about is stablecoins, which actually bridges traditional money with cryptocurrency. So as the name suggests, stable coins are a type of cryptocurrency designed to maintain a consistent value, unlike their much more volatile counterparts like Bitcoin or Ethereum. They achieve this stability by linking their value to more stable assets, okay? Typically traditional currencies like the US dollar. So there are three main types of stable coins. The first being fiat collateralized Stablecoins. So when I use the term collateralized, collateral is basically an asset you put up as security for a loan in case you default. So if you default on a loan, then the issuer of the loan can then go after your asset to pay off the debt. So fiat collateralized stablecoins are backed by traditional currencies like the US dollar. Okay, so for each digital coin, an equivalent amount of real currency is held in reserve. So think of it as a digital version of a dollar bill that you can always exchange back for a real dollar. Secondly, crypto collateralized stablecoins. These are stablecoins backed by other cryptocurrencies. So these are often over collateralized to account for the backing cryptocurrency's volatility, okay? So as an example, instead of using gold, other digital currencies are used to back a currency. And the third are algorithmic stablecoins. So these are not backed by any asset. So this is where computer programs are used to automatically adjust the supply of coins to maintain a stable price. And this is actually similar to how central banks manage the money supply, but this is done automatically by computer code. So why do stablecoins matter? Well, they provide a bridge between financial systems. So they make it easier to move money between traditional banking and cryptocurrency systems. Their stability is important, so that unlike Bitcoin and Ethereum, stablecoins aim to maintain a consistent value, okay, making them more suitable for everyday transactions. Efficient transfers, moving money between cryptocurrency exchanges is often faster and cheaper using stablecoins. Global access, so in countries with unstable currencies or even limited banking, stablecoins offer a way to use a stable currency digitally. In the use of these stablecoins, there are some challenges to consider. So firstly, users must trust that fiat collateralized stablecoins actually have the reserves they claim. On the regulation side, governments are still developing rules for stablecoins, which could affect their use and value. And security risks, like all digital systems, stablecoins can be vulnerable to hacking or technical issues. So in simple terms, stablecoins combine the stability of traditional money with the digital flexibility of cryptocurrencies, okay? In conclusion, well, blockchain technology and cryptocurrencies have introduced revolutionary concepts like public and private blockchains, mining, and stablecoins. Despite the challenges, their potential to enhance that transparency, security, and efficiency across industries is significant. So as the blockchain technology evolves, it will likely play an increasingly important role in our digital lives, reshaping concepts of money, contracts, and ownership. So the future of blockchain and cryptocurrencies is still unfolding. Therefore, staying informed about these technologies is absolutely crucial as we navigate this digital and financial future. So if you've actually learnt something today, you've enjoyed the video, please subscribe to my YouTube channel, Digital Skills with Andrew, where I've got a number of videos in the digital skills niche, okay? Please share the video with your friends or anyone who will benefit from their content. And until I see you in my next video, stay informed.